Good morning. I'm Andrew Zezas. Welcome to the CFO IntellStats Index review, hosted by Real Estate Strategies Corporation and CFO Intelligence. I'm so glad you could join us today. Today's discussion is the latest in a quarterly series of virtual presentations on CFO IntellStats, the results of the business sentiment survey completed by CFOs and other senior finance executives. Thank you very much for being with us. Watch your inbox for invitations to attend future events like this. Now, during today's discussion, please post your questions in the chat room, and we'll do our best to address them during the session. I have the pleasure of serving as publisher of CFO Intelligence Magazine, host of the CFO IQ on-camera interview series, and chief strategist and CEO at Real Estate Strategies Corporation. In doing so, I advise CFOs across North America on business, real estate, and career topics. Today, I'm joined by my colleague, Marty Daks, editor of CFO Intelligence Magazine and the CFO IntellStats Index. Today, Marty and I will share with you the results of the Q2 2026 CFO IntellStats Index. I'm also excited to tell you that we're joined today by a special guest and subject matter expert, Patrick Westerhouse. Patrick's partner in the advisory group and cyber risk services of Eisner Advisory Group. Now, after Marty and I discuss the CFO IntellStats Index, Patrick will present a very exciting discussion entitled Digital Breach, When One Click Costs Millions. Today, we're broadcasting this discussion live via CFOintel.com. Now, stick around, because at the end of today's discussion, I'll have two special offers for you. Now, remember, if you have questions for Marty or me or for Patrick Westerhouse, post them in the chat room. And as I said, we'll do our best to address them during today's session. And now, let me introduce you to my colleague, Marty Daks. Marty Daks is a former, I like to say, recovering accountant and seasoned journalist. He's written for well-known publications such as University of Pennsylvania's Wharton School's Knowledge at Wharton, University of Chicago's Booth Review, NJ Biz, and Commerce Magazine. Marty currently serves as editor of CFO Intelligence Magazine and the CFO IntellStats Index, as I mentioned before. Marty, I'm so glad we're presenting together again. I'm glad you're here.
Thanks. This will be exciting, Andy.
Yeah, this will be great, as it always is, Marty. So why don't we jump right into it? Okay, let's jump into the recent results of the Q2 2026 CFO IntellStats report.
Okay, so I've been staring at the CFO IntellStats Index Q2 numbers for a couple of days now. Andy, I got to say, I think this is probably the most important IntellStats report we've covered all year. In this quarter, CFO confidence didn't just soften, it cracked, at least in some specific places. AI enthusiasm, for one thing, dropped from 67% in the first quarter to only 44% in Q2. To me, that's not a gentle cooling, that's a reversal.
Marty, I'm going to push back on the word crack right out of the gate. To me, a crack implies something is broken. What I see in the data is not a crack, but more like a recalibration. CFOs are doing exactly what they're paid to do. 67% of those executives who reported to us they're saying that AI will significantly reshape their operations after one good quarter. That's not a sustainable number. It never was. That was hype cresting. And with 44% calling the impact moderate, that means that CFOs are getting honest about the implementation timelines. That's not fear, that's maturity.
You call it maturity. Is it that, or is it buyer's remorse? Because I'm looking also at the technology budget numbers, and those tell an even harsher story than the sentiment numbers do. significant increases in tech investment. That's a leading indicator, and that dropped from 50% to 22%, more than half gone in one quarter. Andy, if that was just executives getting realistic, you'd expect the sentiment to soften gradually while the dollars keep flowing on projects that were already greenlit. Instead, we see the money getting pulled back just as fast as the enthusiasm did. I'd say that looks like CFOs who overcommitted in Q1 are now trying to quietly walk it back.
Mm, I don't know, Marty. Some of that may be true. I'm not going to pretend otherwise, but you're reading a single quarter swing as a trend line. And I think that's the mistake a lot of people are going to make with this report. Look at what's sitting right next to the AI numbers. Interest rate optimism collapsed even harder, from 50% of CFOs expecting a positive effect down to only 22%. That's not an AI story, that's a macro story. When CFOs get nervous about the cost of capital, everything discretionary gets trimmed. And technology spending is one of the most discretionary line items on most P&Ls. I'd argue that AI pullback is a symptom of rate anxiety, more budgetary than tech focused, and not a verdict on AI itself.
Okay, that's a generous read. I think you're partly right, but again, only partly.
Only partly. Okay,
Only part.
I'll take that.
I'll give it to you because if it was purely a capital cost story, I would expect facility spending and other categories to get hit too, but they didn't. 44% of CFOs still plan to expand their physical footprint. And that's barely off of Q1's 50%. And at the same time, zero plan to shrink their space.
All right, that's fair. And that's actually one of the numbers I find most interesting in this entire report. So I'm glad you brought the conversation there. CFOs are not retreating from commitment, Marty. They're retreating from ambiguity. Real estate decisions come with a defined return, a defined footprint, and a defined operating and headcount plan behind them. AI transformation projects in Q1 were being sold, and I do mean sold, by vendors on projected productivity gains that were often theoretical. A CFO can underwrite a lease. It's much harder to underwrite a significant reshaping of operations, especially projected in advance, when nobody can show you the reshaping or its actual impact yet.
Okay, so now I guess we're agreeing that the AI number was likely inflated to begin with.
Yeah, I'll agree it was aspirational. I won't agree that it was wrong.
Okay, but that's a fine distinction when you got a room full of CFOs who now have to explain a half tech budget to their boards.
Yeah, well, it's not a fine distinction, Marty. It's actually the whole ball game. Aspirational but wrong means AI hasn't yet delivered. Aspirational but early means the delivery timeline finally got honest. I point you to the fact that only 12% of CFOs call AI's effect insignificant so far, down, not up, from where skepticism usually lives in these cycles. Most of the movement went from significant to moderate, not from significant to nothing. So that's not illusionment. That's a company finally reading the fine print on its own pilot program.
Okay, Andy, but let's take that framework you just posited and apply it somewhere that it doesn't hold up quite as well. And
Go
I'm
for it.
looking at M&A because deal making focus has now fallen for 3 consecutive quarters, 63% at the end of 2025. Then it fell to 50% at the close of Q1, and in Q2, it fell again to only 20%.
Mm.
That's not a single quarter wobble. That is a trend, and that's a slope, Andy, you could ski down. And and unlike AI, no one was overselling M&A appetite in Q1. 50% of CFOs who wanted to increase deal focus, that was a thoughtful number to begin with. So, what are you gonna call it now when we see a steady decline? And that decline is off of a baseline that was already at a relatively reduced level.
All right, so that one I'll give you almost entirely. But
Thanks.
yeah, but Marty, M&A is the real story of this report, more so than AI, more than interest rates. 3 consecutive quarters of decline is a pattern, not noise, and I think it reflects something CFOs are more honest about privately than publicly. Valuations still haven't fully reset to match the cost of financing a deal. You've got sell anchored to 2021 era multiples and buyers underwriting to an interest rate environment that just got worse in the same survey. 56% of CFOs now expect rate changes to hurt their companies, not help. Put a stubborn seller and a spooked buyer in the same room 3 quarters running, and the pace of deal making is absolutely going to keep shrinking. I don't think that that'll reverse until rate expectations stabilize in one direction or the other. Right now, rate expectations are deteriorating, and deteriorating expectations kill deals faster than bad expectations that have leveled off.
Okay, now pair that with the question that we pose to CFOs about their near-term strategic focus, because I think it actually supports your point, even better than mine. M&A used to be one of the headline priorities CFOs named for the year ahead.
Absolutely.
Oh, okay, but now it's tied for last.
Mm.
Only 20% of CFOs cited that. Lump that in with cybersecurity and HR, and that's behind a 40% cluster of legal, operations, and sales and marketing. Andy, when M&A drops from a leadership priority to an afterthought, that is not caution. That's CFOs quietly taking M&A off the table and turning elsewhere.
Yeah, but Marty, turning elsewhere, that's not a criticism in my book. It's actually a strategy. Legal, operations, sales, and marketing at 40% combined tells me CFOs are optimizing the business they already have instead of chasing business that they might acquire. That's textbook late cycle discipline. I'd rather see a CFO tightening operations and protecting margin on existing revenue than swinging for a transformational acquisition in an environment where financing costs are trending the wrong way. The companies that get hurt in cycles like this one are those that keep deal making on autopilot regardless of the rate backdrop. And that's a challenge.
Okay, I won't disagree that discipline is smart. I mean, not going to argue that, but I would disagree about discipline being free. There's a cost to it because while everyone's turning elsewhere on operations, another key number, labor, that's
Sure.
turning against them.
Yep. Yep.
According to the most recent IntellStats survey, 44% of CFOs now say attracting and retaining employees is getting harder. That's up from 33% last quarter. And at the same time, the percentage of CFOs expecting no change in hiring difficulty, that dropped from a half to a third. You can't run on an operations and sales and marketing playbook unless you have people who can execute it.
Right.
This report says it's getting harder to hold on to people, and that's at the same time that CFOs need them the most.
Okay, so in the second quarter, 44% of CFOs want 3 or more days a week in the office. They want their employees in the office 3 or more days.
Mhm.
And that's up sharply from about 33% in Q1. You can't tell me with a straight face that pulling employees back into the office 3+ days a week is a retention strategy in a market where retention's already getting harder. That's not a response to the hiring problem, Marty. In a lot of organizations, that actually may be a cause of it.
Let me respectfully disagree because I think you're being too hard on the CFOs here. Return to office, I don't see that just as a retention lever. I see it also as a productivity and a culture lever. I- There's a case that some of this hiring difficulty is actually self correcting. Companies that are going back to 3 days a week, I think they're actually filtering for the employees who actually want to commit to the company and be there. And
Okay.
they're actually shredding those that don't have that commitment.
Shredding
I
or
don't,
shedding? Shredding or shedding? I hope they're not
sorry,
shredding.
shedding, shedding those who don't. You're right. We're not going to shred them. I don't think Department of Labor allows that.
No, no, that's against all.
This shedding, that's not accidental. I think that's an intentional calibration of the workforce, and that's the same word you used for AI a few minutes ago.
Yeah, I said it was a recalibration, and I'll take the word back if you're gonna use it against me that skillfully. But there's a difference between AI spending, which is a budget line of that CFOs control unilaterally, and workplace policy, which runs through an entire employee base that gets to vote with its feet, right? So if 44% of companies are finding hiring harder at the exact same moment that 44% of companies are demanding more office days, I think the more parsimonious explanation is that these numbers are colliding, not complementing trends. You don't get to claim intentional filtering unless you can also show me the applicant pool held steady. This report doesn't show me that. It shows me two numbers moving toward each other, basically on a collision course.
Okay, what if we put a pin on that one? Because honestly, I don't think we've got enough data to fully close it out.
Okay.
Okay, but here's a number I think you might actually enjoy defending: supply chain,
Mm.
because concern about meaningful supply chain disruptions that rose from 33% of CFOs in Q1 2026 to 44% now. And that happened even while concerns over tariffs eased off. We've only got 11% of CFOs saying they expect a significant negative impact from tariff policy. That's down from 17%
Right.
previously.
Right.
So, can you explain that to me? Because on the surface, I don't think those two numbers should be moving in opposite directions.
Yeah, I'll explain that happily, actually, because I think it's actually the cleanest signal in the entire report. Tariffs are now a known quantity. Whatever is your view of a policy, CFOs have had multiple quarters to model tariffs, hedge them, and reprice contracts around them. Known risks get priced in and confidence about them stabilizes, sometimes even improves, simply because the uncertainty is gone. Supply chain disruption is the opposite. It permeates everything. It's global. And this quarter, it's compounded actually by, surprise, surprise, immigration policy effects. Last quarter, only 17% of CFOs expected at least a moderate negative industry impact from US border policy, but that jumped to nearly half this period. That's a labor and logistics story, not a tariff story. Immigration policy, Marty, touches everything from warehouse and office staffing to agricultural inputs to construction timelines on that same facilities expansion we talked about earlier. I'd argue that the supply chain number is picking up immigration policy anxiety more than it's picking up trade policy anxiety.
Okay, maybe that's a sharper connection than I'd make, and I I'll concede that. But if it's right, I think it actually undercuts your inventory argument. Now, Andy, I know you haven't even made an inventory argument yet, but I think I know where you're headed. I bet you're going to tell me that the fact that 89% of CFOs plan no change to inventory, and that's up from 83%. I bet that you're going to say that's more discipline, more confidence in the current setup.
That's exactly where I was headed.
And I think it's the exact opposite because if supply chain concerns are rising and immigration linked labor disruption is rising along with that, I don't think flat inventory is confidence. I think it's paralysis. I think nobody's building buffer stock against the supply chain risk that they told you they're worried about. That 11% who plan a modest inventory increase, and that's up from 0 last quarter. I think that's a more honest number than your 89%. I think that's the beginning of a hedge.
Mm.
The 89% represents CFOs who haven't decided what to do yet, and they're defaulting to no change because it's the easiest box to check on a survey.
No, no, no. I actually think that's way too cynical about how these surveys work. But I'll grant you the shift from 0 last quarter to 11% of CFOs who are now planning inventory increases, that's worth watching next quarter. If that number climbs to 20 or 30% or more while supply chain concerns keep rising, you'll have won this argument, and I'll even say so on record. Where I won't concede is calling 89% paralysis. Inventory carrying costs are they're real money, and they're sitting on a balance sheet. And in a quarter where 56% of CFOs expect interest rates to hurt them, holding inventory flat is capital discipline. It's not indecision. You don't build buffer stock preemptively against a risk that's still diffuse. You build it once the risk is specific and understandable. This report shows a specific risk: immigration linked labor disruption. And that's emerging for the first time. You've got to give it a quarter at least to sharpen itself before you call flat inventory a failure to react. Then maybe.
I'll take that bet, Andy. But let me finish where I think the report actually closes. And I think that's where we ask CFOs about their strategic focus. I think this could be the most revealing number in the whole survey. And we've actually only touched that in passing so far. Legal, operations, sales, and marketing, that combined for 40% of their strategic focus looking ahead. Cybersecurity HR, and M&A, that tied at 20% each. You compare that to Q1, where the list was headlined by cybersecurity, M&A, and supply chain, that's not a modest shift. I'd argue that CFOs who are abandoning an outward-facing growth and defense posture for an inward-facing cost reduction posture. I think that's the most honest sentence in the entire report. Leadership stopped playing offense.
Hmm. You make a good case, Marty. I'd actually call it the most honest sentence as well. We just disagree on what it means. You're calling it defense. I'm calling it focus. Every one of legal operations, sales, and marketing is a function that directly touches revenue and risk in the next 12 months. Cybersecurity and M&A are important, but they're also the two functions most likely to have absorbed enormous attention in prior quarters. Cybersecurity, which Patrick Westerhouse will talk a lot about in later on today, because it never goes away as a headline risk. M&A, because it was generally front of mind through 2025. What you're calling abandonment, I'm calling CFOs who finally have bandwidth back because the crisis of the quarter items got resolved or deprioritized elsewhere. This is what a management team looks like when it stops firefighting and starts running the business intelligently.
Stops firefighting? I think that's generous, especially when the same IntellStats report tells us that supply chain risk is rising and hiring is getting tougher. Andy, I think these are fires. They're just not the same fires that were burning in Q1.
Yeah, no, they're definitely fires for sure, but they're smaller ones, and that's the entire arc of the current IntellStats report. If you step back from any single data point, Q1 was a period of big synchronized optimism. AI, rates, M&A all moving together almost too neatly. Q2 was a period of CFOs sorting that optimism into what's real and what's not, and discovering the answer is different for each of those categories. AI, real, but slower. Rates, worse than hoped. M&A, still stalled. Facilities, still strong. Inventory, still disciplined. That's not companies in retreat. That's management doing its job, pricing risk category by category instead of riding one wave of sentiment.
I I think, Andy, you've just described companies that are being more selective, but without admitting that they're also getting more anxious. Every number in this report that improved tariffs, inventory discipline, that's a number about something that's already known and already priced. But every number that degraded AI enthusiasm, rate optimism, M&A appetite, hiring difficulty, concerns about supply chain, immigration exposure, each one is about something that CFOs don't yet fully control. To me, that pattern isn't discipline. It's more like CFOs who are holding steady w- wherever they already have certainty, but they're pulling back everywhere they do not have certainty. That's a defensible posture for one quarter, maybe, but if it's still the same posture in Q3, that would get me worried.
Yeah. Yeah. You know what? On that, Marty, we actually land in exactly the same spot, even if we got there arguing the whole way.
And what we
If
do?
if Q3 shows the same pattern, retreat in the categories tied to uncertainty, hold in the categories tied to control, then your read of this of the IntellStats report data, it wins, and it becomes a story about anxiety, not balanced expectation. If instead AI sentiment stabilizes, rate expectations firm up in either direction, and M&A finds a floor instead of a fourth straight quarterly decline, then Q2 is exactly what I've been calling it. The quarter CFOs got honest. Either way, I don't think anyone should read this index as a single verdict. It's a point in time. I think they should read it as the first data point in a two-quarter test going forward.
A two-quarter test. I like that, and I can live with ending on that, even though I still think I'll be the one saying, "I told you so," when Q3 lands.
All right, Marty, you're on record. I'll be just as happy to remind you which one of us called it honesty first.
Okay, and what one more point, if I could, before we close, Andy, because I don't think we fully accounted for the effect of the immigration number on deal making specifically. And let me zero in. If 44% of CFOs now expect immigration policy to meaningfully affect their industries, and that's up from almost none in Q1, don't you think that sort of creates exactly the kind of regulatory uncertainty that kills acquisition appetite? I mean, you're not going to buy a labor intensive target when you're not even sure what your workforce costs or availability look like 18 months out.
That's probably the single best explanation we've landed on today for the M&A slide, that slope you were talking about.
Mm.
Pardon me. And I want to make sure it doesn't get lost. So deal makers underwrite forward workforce assumptions as part of any acquisition model. And if immigration policy is suddenly a variable that nobody can pin down, well, that could add a discount to any target in a labor exposed sector like manufacturing, agriculture, hospitality, construction, logistics, and others like them. It doesn't just soften appetite broadly, it probably soaks up appetite disproportionately in exactly the industries most likely to have been active deal makers a year ago. That's a more targeted explanation than the blanket rates are scary story that I was leaning on earlier. So I have to admit that.
Okay, two last observations. One, I'd like to just return to cybersecurity for a moment. And I know Patrick's going to be talking about this also.
Yep.
But I want to note that according to a statement from IBM, cybersecurity spend appears to be getting crowded out, at least to some degree, by AI spending.
Mm.
And I think that's not just a good trade-off. I I think that
Yeah.
again,
Wait, are you saying it is a good trade-off or not a good trade-off?
I think that's not a good trade-off.
Okay. Okay.
And I think that Patrick will be focusing on the dangers of shorting cybersecurity budgets. And again, he'll go into more detail.
Yeah.
And second, and this I think is some good news, Andy, as I always do, I benchmarked our IntellStats Index quarterly results against another one,
Mm.
the Duke University and Federal Reserve Banks of Richmond and Atlanta CFO survey. And the headline of their most recent report, which was issued June 24th, is consistent with ours. They noted that, quote, financial decision makers' outlooks worsened this quarter amid heightened concern over rising costs and prices in the second quarter of 2026. And since their last survey, CFOs added 1.1 percentage point to their own firm's unit cost and price growth projections for 2026. End quote. Not only that, another data point, the GEP Global Supply Chain Volatility Index, and that's produced by S&P Global and GEP. They noted that, quote, businesses continued building buffer inventories, driving another month of strong demand for raw materials, commodities, and intermediate goods.
Well, first of all, it's good that the Atlanta Fed agrees with us. But
They're
I'm very
happy.
I'm very glad that you benchmarked. Those are very useful checks on everything we've just discussed because they actually mean that we're not looking at the CFO IntellStats specific mood swing, and that they're corroborated independent data that's pointing at the same quarter. And I'd actually connect these directly back to the two numbers we spent most of our time on today. Rising cost and price projections are exactly what you'd expect to sit underneath both the rate optimism collapse and the M&A pullback. If a CFO, Marty, is quietly marking up their own cost-based expectations by over a point, that's margin pressure showing up before it shows up anywhere else in the income statement. And margin pressure is precisely what makes a CFO less willing to pay 2021 era multiples for a 2026 acquisition, and less willing to bet that rate relief is coming to bail out the math. So rather than undercutting my recalibration, not retreat argument, I think the Duke Fed and GEP numbers actually explains the mechanism behind it. CFOs aren't just reacting to sentiment, they're reacting to an input cost line that's moving against them in real time. And every other number we debated today is downstream of that.
Okay, so Andy, I guess you could say that we've each talked the other into revising their position. On my part, I'm conceding that the tech pullback looks more like precision than retreat, especially once you separate vendor over promising from genuine buyer's remorse. And I think that you're sharpening the M&A story beyond simply rates are scary into something workplace or workforce specific. I think that's probably one of the healthiest outcome one of these conversations can have.
Well, I agree. I think it's actually the only outcome worth having. The report doesn't hand you a verdict, doesn't hand the reader a verdict. It hands the reader a dozen indicators moving at different speeds. And our job is figuring out which movements are noise and which are the beginning of something real. My read of the current IntellStats report, CFO IntellStats report, is that the data mostly tell one coherent story, just not the alarmist version. Yours is that it's one uncomfortable quarter away from turning alarmist. Oh my gosh, oh my gosh. That's genuinely useful disagreement for us to leave on the table rather than resolving artificially for a tidy ending in today's presentation.
Okay, I'll agree with that until Q3, Andy.
And until Q3, my friend, we'll let the CFOs decide who's right.
That works.
Ladies and gentlemen, I'm going to ask our producer, Joe, to post the recent issue of the CFO IntellStats Index in the chat room so you can download it while you're here today. To our guests, as I mentioned earlier, stick around after Patrick Westerhouse's presentation, which is coming up next. I have a couple of special offers for you. And now, please permit me to introduce you to our very special guest and our friend, Patrick Westerhouse of Eisner Amper. If you've got questions for Patrick, remember, post them in the chat room, and we'll do our best to address them after Patrick completes his comments. Patrick A. Westerhouse is a partner in Eisner's Cyber Risk Services practice. With nearly 25 years of experience, Patrick provides investigative, consulting, and litigation support to clients facing cyber risk, fraud, financial crime, national security, and regulatory scrutiny. Patrick advises Fortune 100 and 500 companies, financial institutions, entertainment, energy, fintech, insurance organizations, private equity firms, and government agencies on cyber crime prevention, anti-fraud, anti-money laundering, cryptocurrency, and even national security matters. He brings a unique blend of law enforcement, forensic accounting, data, and technology expertise, helping organizations strengthen defenses against evolving digital and national security threats. As you can tell, Patrick's no slouch. Patrick's experience includes having served at the FBI, where he led high-profile investigations into corporate and government fraud, anti-money laundering, public corruption, counterterrorism, espionage, and cyber fraud. He built the Cybercrime Intelligence Unit for a top 5 financial institution. Patrick founded a technology company and has successfully built multiple consulting practices. His work has included developing blockchain monitoring tools, fraud prevention technology, managing multi-agency investigations, and creating cyber fraud fusion programs for global financial institutions. Earlier in his career, Patrick conducted audits and forensic reviews at a Big Four accounting firm. Patrick also served as a witness in federal grand juries and trials. He's a published author and has been a featured speaker at cybersecurity, anti-fraud, and law enforcement conferences worldwide, sharing insights on topics such as cryptocurrency, digital exploitation, and international transnational criminal threats. Today, Patrick will present Digital Brief, When One Click Costs Millions. Ladies and gentlemen, it's my pleasure to introduce you to our friend Patrick A. Westerhouse, Partner Advisory Cyber Risk Services, Eisner Advisory Group. Patrick, it's so great to have you join us today. Thanks very much for being here. Can't wait to hear your discussion.
Thank you very much. Pleasure to be here. I'm super excited to be here with you all. And so good afternoon and welcome. I appreciate your time and I appreciate the time you're giving me to talk to you about what I see as a evolving thing that CFOs are more and more going to have to be participating in and managing, which is cyber risk. Given the threat and how it's increasing. I think in their previous conversation, they talked about how the AI spend maybe is going up, but cybersecurity spend is going down. And I'm here to make the argument and at least to lay out for you that those should be going and working together. Just given the fact that the ease and the barrier of entry to be able to get into and to become a cyber criminal is lessening. And so before I get into my full presentation, what I'd like to do is walk you through a journey actually and tell you a couple of stories about how I arrived today and talking to what I consider the most important groups within companies to manage this ever-growing problem. And it really starts with going back when I was back in the FBI. So for a better part of 10 years after chasing fraudsters, money launderers, terrorists, and corrupt officials all over the world and the globe. Crime was progressively going online, and after recognizing this and coming into a discipline of computer forensics, I dipped my toe and went into the cyber division of the FBI. And again, after 10 years as a case agent, I'm looking around and I'm getting involved in investigations and really wondering why, at its core, the FBI was ignoring some of the most critical, important things to focus on that cyber was facilitating. And so let me take you through a couple of examples. I get involved in a pretty extensive investigation that was enabling fraud at scale, going after our great banks and our financial institutions. And what bad actors were doing were creating malicious software to be able to exploit accounts from Wells Fargo to Bank of America to Citibank and really everybody between. And these individuals were facilitating the theft of hundreds of millions of dollars. And after looking at how the investigations were being approached, I was really scratching my head because I would get on the phone with these case agents and I would start asking them, like, where are the bank subpoenas? Why are you not following the money? Because what I see is a ton of money that's actually being stolen, laundered, and actually, I can see this money going into bank accounts that are then going and buying things like Ferraris and mansions and all sorts of things sitting in Florida. I get that you're focused on the bad actor that's sitting in Eurasia and you're really focused on the tool and how the crime is being committed. But what you're not doing is actually focusing on what could really disrupt this. And this is really where it kicked off my philosophy, my theories. I've gone along in my career since leaving the FBI and thinking about cyber more so from a financial perspective and less so as a technical risk. And through my journey over the past 10 years, what's really become evident after working with some of our really great companies here in the United States, and unfortunately in bad circumstances in a post-breach scenario or a litigation scenario, or they're calling me up because they had, a malicious wire that left their organization as a result of something that's called business email compromise, or they've had the theft of tons of money. They're really left scratching their head saying, I thought we had everything under control and we had cybersecurity and we had good compliance and we had all the tooling in the world. And unfortunately, while that may be one side of the equation, what they're failing to realize or what they're failing to do is to really understand what is that getting you in terms of financial risk management. Because cyber, as I look at it and how people have to think about it, facilitates largely fraud, theft, and espionage. And what I mean by that in the private space is fraud, yes, stealing of money, theft, which is really what you hear about in the papers and in the big ransomware campaigns, which is just a smash and grab. And espionage, that's a fancy term these days for just intellectual property theft, which is an absolutely growing concern. And as your great companies and your individuals are looking to adopt and use AI and build really consequential proprietary things that you're going to be able to use, your intangible assets are going to go up, and those things are going to become very valuable. So, what are you doing to proactively understand how you're protecting the most important things to your organization? And while relying upon your IT team, your cybersecurity group, yes, that's fine. But after leaving the FBI, I made a very critical decision. And what I've seen is the government is not going to out indict their way out of, and what I say is indict their way and arrest their way out of this problem. And believe it or not, since leaving the FBI in 2016 and coming into the private world, I've made and helped mitigate more bad actor and bad actor activity than I ever did as an FBI agent. And that may sound astounding. That may sound like, holy, what are you talking about, Patrick? Unfortunately, that's the reality of how this threat has matured. I truly believe going into 2026 and in 2027, the threat is escalating significantly just because the amount of data that's been taken and frankly the entrance to barrier or the how easy it is for anybody to become a cyber criminal. You don't need an advanced computer science degree. You don't need to know how to code. You don't know how to hack. You actually just need to know how to go into a marketplace and be able to buy access. You just need to know how to get at information that's sitting in the open source to be able to social engineer somebody. You need to actually be really good at business to be a cyber criminal today. And so the population is widening. And so what does that mean as a CFO? That means doubling down and figuring out exactly what your IT and security teams are doing to help them measure the risk that they're mitigating from a financial perspective, not from a technology perspective. So I'll get into some few slides, which are going to be very stat heavy and very stat driven. But what I really want to impart on you as you think about this presentation, and what I'm not trying to say is that, oh, I'm putting something back on your plate that is very difficult to manage because usually what comes to me is a lot of mumbo jumbo and technical jargon, which is the case. I'm here to help simplify it and help you think about it in a different way. And so usually what I start with is this very key question here. And if you're brave enough to put it in the chat and your answer, that'd be wonderful. I just know that when I talk to groups that are CFOs or financial managers of companies, when I ask them the critical question and really, and this is the one that I'm going to repeat at the beginning of the presentation at the end. If the breach cost, you took your core systems down for 4 weeks, and at the top of that slide, you'll see Simultaneously, you're getting these things coming at you. And you're sitting there as the CFO and you're running investor communications, you're trying to communicate to the board. You're ultimately going to be responsible for helping to manage all these things that are coming at you at the same time: litigation risk and ransom demands and customer problems and investor relations. You have to ask yourself, and sitting there and looking at your the financial health of your company, do you have both the liquidity and the insurance to cover it to be able to survive? Unfortunately, there's a lot of examples that you see in the headlines where that's not the case. And I can give you example after example where unfortunately CFOs who are sitting in this position and saying, wow, I thought we had the A team. And you probably did from a technical perspective. I thought my general counsel was all over getting us adequate cyber protection. And they probably were, and they did the best that they could. But unfortunately, the system is designed for the broker dealers and not necessarily the insured. Um, why is it when I'm filing my business interruption claim after this massive attack that I'm getting cents on the dollar? And I can't tell you how many times I've had to sit in front of CFOs. And it's an incredibly stressful situation. So I can't foot stomp this enough. But really, if there's one thing to walk away from this presentation is if you can honestly answer that, then great, and you're better prepared than most companies out there. But if you can't, the good news is there's a pathway to get it done and to help you get into a better position. So I'm sure a lot of you, if you're overseeing that program and have direct oversight into the IT budget spend and the security spend and things like that, I would bet 9 times out of 10, people are coming to you or your leadership is coming to you with 3 different areas to say, oh, we're good. Don't worry about it. We're sufficiently going to survive a massive attack. They usually lead with, oh, compliance. While compliance is very important and you need to follow compliance and regulatory requirements that are only becoming more robust and more difficult to manage, compliance doesn't mean you're actually going to be in a position to be able to survive how fast and what the bad guys are doing. Because as soon as you think you have good compliance, that's fine and you're doing all the right things, then usually it flips to the next thing, which is, oh, we need more tools to be able to keep up with how bad guys are innovating and how the criminal nation state groups are exploiting our technology. But what I just attest to you at the beginning of the conversation is this is not a technology on technology battle. You're not going to be able to out tech your way out of this problem. The more tools and the more things that you put in your environment, and I hear this all the time, chief information security officers want to believe that we're going to be able to just put more stuff in and protect the endpoints and the computers and the devices, and that somehow we're going to stay one step ahead. Well, I hate to tell you that's not going to be the case, particularly given the fact that the headlines are now looking at how AI tools are able to break and be able to discover vulnerabilities with the technology faster than it's ever done before. So is this really a technological solution? I would say not. It's an important part of the equation, but it's not the thing that actually matters. And then essentially the myth, right? The rolling myth around and the tooling myth. Um, that if we just continue to leverage and use more of these things and we not focus on really how we're being exploited, then you're ultimately not going to move the needle on what I think is most important, which is managing the financial risk part of this. So I'm going to make the argument here, given all these stats, you have to ask yourself, and being a throwback CPA, this is usually what I would call the throwdown slide, or these are stats that you just cannot argue with. So if the compliance is working and functioning and the answer is throw more tools, throw more technology, really get after this, then why are these numbers continuing to go up and to the right? And again, you'd like to see this going the other direction, but this is looking like the bull market that we have today. You're seeing fraud numbers that are going off the charts. And these aren't just stats that Patrick's putting down that are not sourced. These are coming from the very respected organizations of the Association of Certified Fraud Examiners. This is coming from the Internet Crime and Complaint Center, which is run by the FBI, which aggregates stats up for how many people have become a victim to cybercrime. Fraud is becoming, and I make the argument, a national security problem. The amount of money that is being exfiltrated out of our economy is an astounding pace. We're the only Western country that doesn't see it as a national security problem. The UK has fully adopted it. And it's maybe because our gross domestic product is so big that this still doesn't move the needle. But to me, that fraud number points to a lot of companies, small, medium, and large, losing a ton of money, That points to a lot of people losing their wealth, losing their savings. These are real dollars, folks, and it's not going the other direction. Theft and IP, theft of IP. I said this from at the beginning of the presentation. I got my first taste of this when I was involved in a national security investigation. That this is all public and public knowledge. But when our F-35 and all the intellectual property was stolen from our great defense companies by the Chinese, I was looking at a group of people that were facilitating this, that were mercenaries, Chinese mercenaries that were hiring loads of hackers and using multiple different tactics to be able to steal the information that now resulted in the Chinese fighter planes looking exactly like ours today. That's just one example of what's happening every day across our country, where intellectual property is being taken at scale, and CFOs are left to thinking and scratching their heads. They're like, what are we doing to protect these things? Intangible assets are just most as important to me as our hard assets. So focusing on that aspect of it is only going to become more critical, right? And so I've talked a little bit how this ties into the espionage scenario, but people have to really understand in companies and CFOs that cyber risk is financial risk, and this is what I mean by it. Real dollars are leaving, real assets are being impaired. So how are you better preparing yourself to do this? Now, I'm gonna draw on something that a lot of technology leaders and CISOs don't like to highlight, but really, when you pull back and do root cause analysis on so many of the things you read in the headlines and all the big cases that happen and just the financial carnage that's being reported by the Wall Street Journal and New York Times, 9 times out of 10, and I stand behind that stat because I've been involved with so many different incidences, that it's the human being, unfortunately, that's facilitating a lot of this carnage. And what I'm talking about is, and I'm not necessarily you have a bunch of people walking around your organization that are looking to sabotage you. It's just the reality of what criminal groups and nation state actors have at their fingertips. There's been an incredible amount of data stolen, people. 15 to 20 years of information that has been absolutely pilfered out of our country from our great companies. We're talking everything in the personally identified information lane, social security numbers, credit card numbers, usernames and passwords, telephone numbers, home addresses. These people have all of that information at their fingertips, and they're building big data lakes to figure out exactly who they need to go after within a particular organization to be able to exploit them for what they're trying to do, either steal money, conduct a theft, or steal your IP. And so you have to ask yourself, is it really, again, a tooling problem, or do we have to have better visibility upon what information has been taken and what's really the true risk walking around my organization? And I would attest to you, it's the human element. Not over and over and over again. We'll pull back and do deep forensics on a case, or we'll look at the root cause. And you're going to find that unfortunately, it's either somebody that got a phone call and they were social engineered, or they clicked on a fish because they figured out, bad guys figured out how to fish a person because they knew exactly what would lure them into clicking, or CEOs or are impersonated because so much of their information is out there. And so then they're personally attacked, or they go after their families. You're starting to see this go into the physical lane as well. You can't disassociate digital to physical risk. It's all interlinked. And so, how are companies to look at this? Think about this as that next element of managing this problem. It's not technology risk, it's human risk as well. But then, how do you walk that back into managing from a financial perspective, right? So I'm giving a little bit of a sample of what this means. And there's 3 use cases here that I'm sure most people on the phone have probably remembered or learned or read about. But what I'm attesting to you is, on the left-hand side is any general small or medium business that exists today is going to have this level of exposure. And when I say exposure, the amount of data that is existing in criminals' hands, that can tie back to a person that's walking around your building. And so they know exactly their corporate emails, they know exactly where they work, they know the line of business that they function in, and a lot of times they'll figure out exactly who your controllers are, who your AP clerks are. They'll know exactly who are the people within the organization that have the authority to move money and how they can subvert the internal controls to make such things happen. And so I spend a lot of time with companies really opening their eyes about this risk that's really sitting and as evidence of why every company out there has exposure that they don't even know about. And this is what I mean, is that one person's data breach happening in another company unfortunately results in risk for another company. So it's unfortunately just because your company wasn't impacted in reading something, there's probably a good shot that somebody walking around that's one of your employees was impacted. And that risk walks right back into your organization. So, how does this translate into things in real world events that have happened? You look at the Colonial Pipeline. If anybody that lives on the East Coast here remembers that the Colonial Pipeline was shut down for the better part of 2, 3 days, actually a couple of weeks. And so it created massive disruption within the consumer gasoline market. What happened? Well, a username and password was exposed in breached information and previously stolen information that allowed a criminal to log in. Now, all they had to do was log in. There was no secondary authentication mechanism. And after they were able to exploit the systems, they locked the company up and they went right after, guess what, their billing system. So that's why the Colonial had to take it down. They couldn't bill. And that's a direct impact with CFO. Now, the $4.4 million, I think that's really underreported. The amount of damage was much more significant than that. MGM Resorts. How many people on the phone probably got caught up in that? That's most people. If you've ever gone to Las Vegas, you most likely were caught up in the MGM Resort attack. How did that happen? That was a simple social engineering attack. And believe it or not, by a teenager that was sitting in Texas who was collaborating with the Russian ransomware group who had facilitated essentially the ransomware part of the attack. But it was actually a Western teenager who conducted the social engineering attack. And that's where I see the threat continuing to blend in. A lot of people like to point that this is an international problem and this is, other countries' problems. The disturbing thing that I'm seeing in the trend, unfortunately, is that there are a lot of U.S. actors sitting within our soil that are participating in this crime, and that's what I mean by the barrier to entry is going down. Last one I'll highlight is the United Healthcare Change attack. That I'm sure everybody read about. And on a scale like 2.3 to 2.45 billion, that is what I would call material. So again, how did that happen? Username and password compromise. So while it's easy to think that these are very sophisticated things that are happening in these organizations, and in some instances they are, where there's very sophisticated attacks that go on, where bad guys get into networks without people knowing, and they sit and watch and surveil. Most of the time, it's not. It's a very unsophisticated means about how to go after and be able to conduct an attack to be able to get after what they want. So you're thinking to yourself, oh my gosh, what can we do? So yes, prevention and all the things that I've talked about, I'm not telling you, hey, close down the cybersecurity department today and throw my hands up and just get insurance. Please don't walk away with that as, as the solution, because that is not. Yes, it is important to build good compliance, have technology and tools. You just have to. But that's only 50% of the equation today. You have to shrink, as well as they say in the business, the attack surface. So make it harder, but build resiliency in much different ways. And when I say about that is build financial resiliency. How do you actually translate what you're doing from a technological perspective into how do you measure what you're doing from a financial risk perspective? So meaning what I invested in or allocated capital for, what did that really buy me down in terms of true financial statement risk, which is the most important thing to build sufficient liquidity. And then you have to ask yourself, if I can only invest so much and I still have exposure, what can I really do in the risk transfer market? So that's where cyber insurance comes into play. But what I really want to foot stop on that is get involved in that process. Don't delegate it. You really have to pay attention to the T's and C's of these contracts, because remember, just like any other insurance policy out there, it's not to benefit you, it's to benefit the insurance company. And the ability to have claims paid out is getting harder and harder and harder, as you can imagine. So, as I previously mentioned, turn the heat map into a number that the board can fund and the board can understand. By doing this and really thinking that from a financial risk lens, not a tech lens, you're ultimately going to drive better discussion within your stakeholders, who are going to be your boards, your investors, and you're going to have a much more clarity around what you're actually doing. Um, I see this a lot, and I don't know if there's any SEC registered companies on here, but I spend an awful lot of time looking at their 10K as an old auditor back in the day. And with the SEC getting more and more involved in the cyber aspect of it, as of recent years, they've backed away, which in my opinion is probably not the greatest. But a lot of companies are putting disclosures out there about what they are and what they are not doing in cyber. And there's a lot of disturbing trends about what they're actually using in terms of language. And unfortunately, finding gap after gap after gap that really, unfortunately, there isn't a lot of precision about how they're approaching the problem to really manage that risk and be able to really defend the capital outlays, the investments, and how they're really running the program to not only give investor confidence, but client confidence that they have it under control and they're doing their best to protect the most sensitive information they're giving you. So I'm going to come back to what I asked at the beginning of the conversation. And again, if you don't want to put it in the chat, that's fine. I'm happy to take it offline and talk to you about what does this really mean and how do you actually do this. It's so very important. Please challenge your teams. Please challenge your stakeholders. Challenge everybody within your organization, and really do some introspection on the way you're managing this risk. If I had the worst case scenario happen to me in my company, and I had core lines of business that went down, could we survive it? Could we really get through it? And could we come out the other side and continue to move and have our business function appropriately? Um, Unfortunately, so many companies are left in a position where the answer is no. And you read the headlines. A couple other examples. One being a Land Rover. They had a Range Rover. I'm sorry. They had a horrendous breach that took core manufacturing processes down for uh, an incredible amount of time. They lost a devastating amount of money. Something that happened recently last summer in the UK, the Marks and Spencer breach. They had to completely rebuild their systems. The biggest retailer in the UK, so much so that half the management was fired. And now I'm starting to see a trend where, which is, in my opinion, accountability on who actually should be held accountable for a lot of this financial destruction and things that are happening. It's now a shared responsibility. Board members and more C-suite members are being held accountable for what was invested and what was not invested and how the risk was really managed. And so it's no longer a default to say, well, it was our chief information security officer or our head of IT. This is becoming much more of a shared experience, and it has to be. Again, cyber risk is financial risk, and you can't look at it any other way today. So, I make the argument, and hopefully, I gave you some sense of how the reality of what the world is facing and how the threat is escalating, but ultimately not walk away thinking there's nothing we can do about it. There is, and we at Eisner Amper are here to help. We're here to have those intimate conversations and help you shape this up. If you're interested in following up after this presentation, I hopefully you're walking away with some tangible things that you can bring back to your team, you can bring back to your company, to really have these consequential conversations that are absolutely necessary. And I would beg you in your next CFO IntellStats, Andy, I sure hope I see cybersecurity becoming back as a priority operational risk that needs to be managed because unfortunately this problem is not going away. It's only getting worse. And so, but what I'm not suggesting is just pour money at the problem. Be careful, pour money, use resources like everything else that you're doing day to day, measure it, use it, and put capital into it, but figure out exactly what kind of risk you're buying down. So with that, um, I appreciate your time. It's been a pleasure being with you all today. And I'm open for questions and comments and for follow up as appropriate. So, Andy, with that, I'll hand it back to you.
Patrick, phenomenal content. Some of your case studies and historical data were amazing and quite scary, to tell you the truth. But we're so grateful that you joined us today. We've got some questions for you, and I want to pose the first one to you. Basically, from a CFO perspective, for those who are listening today, what would you say is the very first step that a CFO should take tomorrow to reduce risk of a potentially costly breach?
Challenge your head of IT or CISO to show a return on investment. Challenge them to bring forth a metric that shows you what financial risk they have bought down as a result of deploying either people, processes, or technology. Really have them hone in, test their knowledge about, do you even know how our business functions? Do you understand the capital outlay and what that actually is doing to help manage risk for this company? Challenge your leaders. Ask those questions. Demand an ROI, like everything else in your business. Don't just let them get away with giving you matrices that are confusing and technical, and are not easily translatable into business terms.
Excellent, excellent. So a lot of companies say, yeah, this only happens to companies in other industries or bigger companies or smaller companies. For the companies that think, this isn't going to happen to us, what's one real world indicator that that those companies may already be exposed to or be more exposed to than they realize?
It goes back to what I was pointing out in one of the slides around information that's currently sitting in cyber criminals' hands. So it's misunderstood that, again, the digital risk that you actually carry is as a result of everybody around your organization who's been functioning on the internet for decades. And because of that, a lot of their information has been taken in their daily life, whether they've been shopping online or signing their kids up for baseball. All of that personal information is given to other organizations and companies, and they lose the data. They're hacked. Their information is taken. And what happens to that information is it goes to other groups who are then paid to go after companies. So while you think you don't have exposure, I would bet that everybody walking around your organization is at risk because their information has already been stolen 10 times over.
Mm, mm. All right. So one of our online guests, Chris, is asking the following question. Are you seeing more exploitation with bad actors logging in, or authenticating as legitimate users?
Um, I would say it's trending towards the latter, but the former is still a big gap, because a lot of people haven't taken the time to actually do a robust inventory of every which way that somebody can log into your network. And companies are really bad about retiring accounts. So, for instance, when employees leave or contractors leave, a lot of times, unfortunately, they're just leaving the ability to get into the network wide open. They haven't essentially retired those accounts. So, going back to an old accounting thing, CFOs understand, force a good inventory, like do an inventory and to have your leadership demonstrate to you about how you're managing access inventory on a proactive basis. That will really help decrease the ability for somebody not only to not log in inappropriately or take over an identity and log in as a true employee.
So a number of our guests want to know, at what point does it make sense for them to bring in an external advisor to quantify cyber risk and prioritize what actually matters? Because a lot of folks believe, well, this is an IT responsibility. We've got someone in charge of IT. We'll let them manage it. At what point
Yeah.
does it make sense to bring in an expert?
I think it goes back to your first question, Andy. If they give you blank stares and you're asking them to demonstrate an ROI, and they're looking at you with a 1,000-yard stare, or they're confused, I think you have a problem, which means you have a business leader that has no idea how you even make money. So at that point, you need to call timeout and say, hey, listen, we probably need to bring in a blend of experience that understands not only technical risk but financial risk. And that's truly the niche that Eisner Amper is into and creating, and that's the value of bringing in a partner like us.
All right. So Patrick, we know that breaches most often start with people. Tell me the one practical way that organizations can reduce that human risk without slowing down their normal day-to-day business process.
Get curious and get curious about seeing and have visibility on that data that I'm talking about that is sitting at risk that could be easily mapped to employees. It's a very simple exercise that could be done without a lot of effort and a lot of capital that gives you this picture of human risk. And unfortunately, a lot of people don't want to do this because they think it's complicated or they think it's going to be too personal. You can no longer put your head in the sand on this stuff, Andy. You can't ignore this problem. So get curious. And actually, you don't have to do the whole organization. Focus on the people in your organization that matter, the people that drive your revenue, your key asset, your key people in the C-suite, your board, people that have tremendous visibility for your company. I don't think you can't do this anymore from the physical security protection aspect of this. Unfortunately, too many of these, the blend is happening, and you see the attacks escalating, where the cyber and the OSINT and the digital detritus that people have are being leveraged by people that want to conduct physical attacks. So the unfortunate thing today is you can't ignore this. So get curious and start asking critical questions.
Be curious. That's a good guidance. So, all right, let's assume the worst happens, right? Uh, Company gets breached tomorrow. What's
Yep.
one question that CFO should be able to answer about their balance sheet or about coverage?
You're going to be able to breathe easy because you invested in the right way to be able to survive the attack, and you have sufficient coverage, and you have a fairly good understanding of what your business interruption claim is going to pay and what it's not going to pay out. You've done the work. You've done the prevention. You've really dialed this in to know that, listen, even in the worst case scenario, we are going to survive. So, knowing that you do have the capital reserved to be able to survive the things that usually come with this. So thinking about it from a capital reserve perspective, you've done that. And you also know in the risk transfer market where you have done the diligence to make sure that your broker who got you that policy wasn't just a used car salesman. You really held them to task, and to know that your insurance company is actually going to be on your side and not finding any which way to actually not paying the claim.
Okay. All right. So you talked about putting a number on cyber risk. What's the biggest challenge organizations face when trying to actually quantify that kind of risk? I mean, it's tough, right?
It is tough. However, there are platforms that do this very, very well, that are backed with a tremendous amount of actuarial real data, and are consistently being updated with claims information, and that's the key. You want to anchor your process around a tool set and a platform that's been validated and vetted, and is consistently fed with up to date information that's going to give you the best picture of not only how you sit in your industry, because that's very important to benchmark yourself, but is actually based on real science and math. And so that's one of the tools that we've brought to the fight here at Eisner Amper is we partnered with what we believe is the world-class platform to do that. And with our industry knowledge and cybersecurity knowledge and understanding the financial aspect of it, given the fact we are a CPA firm, we're able to actually walk you through that journey and give you defensible numbers that you can actually present to your board and give you reporting that you can stand behind.
Wow. So it can get very specific, very granular. That's awesome.
Very, yes.
Patrick, I got to say, not only is your pedigree and your background incredibly impressive, your knowledge of this industry, haven't heard anyone speak on this topic in the manner that you have. Your statistics and your case study references are excellent. This has been really, really wonderful. I want to thank you personally for joining us and being so transparent, willing to share with us today all the insights that you shared. I hope you'll come back and talk to us again on CFO IntellStats.
Absolutely, Andy. It's been a pleasure. And I can't say enough about the CFO Intelligence Group. They've been a phenomenal partner here for Eisner Amper. To Travis Epp, thank you for introducing me to Andy. It's been a pleasure. Believe it or not, Andy has really pressed me hard about how to up your game, Patrick, and your presentation skills. So I'm walking away with being a better presenter, which is awesome. So, with that, Andy, anytime I'm, as you can tell, I'm super passionate. I've been on a mission since I got into the FBI and this stuff. And I really hate to see, I hate victims. I want less victims, and our great companies are under attack. Our way of life is under attack. And, until the time I retire, it's going to be the mission I'm in. So,
Yep.
pleasure, Andy. And thank you for the time, for the opportunity.
Thanks so much, Patrick. Ladies and gentlemen, if you'd like to contact Patrick Westerhouse directly, you can email him at Patrick, Patrick, Westerhouse, Westerhaus, at Eisner, Eisner, Amper.com. Patrick.Westerhouse at EisnerAmper.com. Now, At the beginning of today's presentation, I mentioned that I'd tell you about 2 special offers. I actually have 3. So before I let you go, let me fill you in. We get very excited when experienced and innovative CFOs share their insights with us. So if you'd like to join me in an on-camera discussion similar to what you saw today, visit CFOIQ.com and drop me a line. Second, if you prefer to share your perspectives in print, perhaps we can publish a story on your ideas and promote your company at the same time in CFO Intelligence Magazine. So if you'd like to explore that alternative, visit CFOintel.com, go to the publications page, and get in touch with me. Now, you can read the latest issue of CFO Intelligence Magazine and request a free subscription at that site as well. Now, our producer, Joe, put a copy of the Q2 26 CFO IntellStats report in the chat room, so download that before you sign off. CFO IQ on-camera discussions and CFO Intelligence Magazine stories are available to CFOs at no cost, and no cost to companies, and also occasionally for select other executives. So here's my third offer. If you'd like to understand in a 15-minute conversation how your company can secure free rent, annual rent reduction, no-cost renovation allowances, expansion or contraction rights, and achieve more favorable terms in its facility leases anywhere in North America, even if those leases won't expire for years, visit realstrat.com and drop me a line. For any of the above, you can simply reach me at any time at andrew.zezas, Z-E-Z-A-S, at realstrat, realstrat.com. On behalf of my colleague Marty Daks and our producer Joe Lara and myself, and also on behalf of Patrick Westerhouse, I'd like to thank you so much for joining us today. Our thanks go to Patrick Westerhouse of Eisner and his team. Watch your inbox for an invitation to the Q3 CFO IntellStats Index review. I'm Andrew Zezas. Enjoy the summer. Stay safe. Come see us again, and God bless. Thanks very much for joining us today. Have a great day.